So, hey, here we are in the Energy Nerd Show.
Who's our guest today?
Our guest is Ian Monroe. He teaches at Stanford and runs a investment fund that does good things like making money and saving the planet.
We invest in that fund. You better be making money. Hi, Ian.
Hey there. Great to be here.
So you sent the graph of how well Etho's doing. Why don't you tell us about it?
So one of my hats, the one that spends definitely the vast majority of my time, is running Etho Capital, which is an investment firm slash fintech company that focuses on investing in the most climate efficient companies, as well as companies that align with overall social and environmental values. So we dive deep into which companies have the least greenhouse gas emissions for every dollar invested, what we call the most climate efficient companies. And we create an index here in the US that we call the Etho Climate Leadership Index. And that index has been traded on the New York Stock Exchange with the ETHO ticker as an exchange traded fund for now over 5 years. And you can see the index has been outperforming S&P 500 and pretty much all the major US benchmarks since it launched back in 2015. The top graph that you can see, I'm pointing to where I'm assuming it's going to pop up, is showing the Etho Climate Leadership US Index versus the S&P 500. And that index is modeled through the ETF that tracks it, the Etho ETF that trades with the ETHO ticker on the New York Stock Exchange. So you don't need to take my word for it. Anybody can put ETHO into Bloomberg or any other financial data platform and see how it's performing for any time period they want to see compared with any benchmark they want to see. And as you can see in the chart, Etho has been doing very well compared with S&P 500. It's still basically moving as the US market moves. When the US market goes down, Etho goes down as well because it's a diversified mix of companies in there. But over time, there's been real substantial advantage with Etho now being over 20% ahead of S&P 500. And that also, you can compare Etho to other US benchmarks like Russell 3000, for example, and it also looks really good. So that's what you're seeing on the top is basically over 5 years of live performance of Etho versus the US market modeled through S&P 500. And then down below it, we're showing a chart of back tests for the prototype of a new global strategy that we're hoping to launch soon. Looking back about 10 years, we're showing basically the same methodology that goes into our US version of Etho applied to the full set of global investments out there. And comparing that against the most common global benchmark, which is the MSCI ACWI, the All Country, All World Index. And as you can see with the Etho global strategy with climate efficiency and ESG in there, it also looks really good compared to the global markets essentially modeled through ACWI, which is probably the most common benchmark that global investors are using out there. Again, you can compare that with other benchmarks on the market. We're hoping sometime soon that Etho will have a global strategy as well as a ex-US international strategy that investors can really easily use to replace their benchmarks. And that's the overall philosophy with Etho is you can, and in most cases will be best off doing broad-based index investing, but you can do it in this smarter way where you're investing in the most efficient, sustainable companies instead of just in everything, which is what conventional indexes essentially are. The funny thing about the investment world is index investing, made popular by Vanguard many decades ago, generally outperforms what's called active investing, people who are stock picking to just pick a few companies they think are going to outperform. If you look at the data, on average, just investing in a global benchmark or a US benchmark is going to do better than a global or US active fund. And those active funds end up being much more variable, much more choppy. With Etho, we're essentially showing what we think is the next natural evolution in investing, which is instead of investing in indexes that are basically everything, invest in indexes that are the most efficient, sustainable companies. You still get this broad-based diversification, but you are not only aligning your investments with your values, you're also just fundamentally investing in companies that are leaders that are more likely to be better investments. It's all about win-wins and just showing that there has been this misconception for a long time in the investment world that you could do good or you can make money. It was an either or sort of thing. And what we're showing with Etho is it really is a yes and, where companies that are more climate efficient, those have lower pollution for every dollar invested, whether it's in the technology sector or in healthcare, different types of consumer products, utilities. Those climate efficiency leaders on average are doing better than their climate laggard competitors that have more pollution. And we think a lot of that is just, we're seeing that these companies are doing more with less. They're just overall operationally more efficient, and there's just direct financial advantages from that. And probably that also is an indication that the companies have better, smarter leadership decision making, where they're empowering continuous efficiency improvements, continuing to innovate. They're not just taking money that should be reinvested in improving their operations and returning it as short-term dividends. So definitely it's not an either or in terms of sustainability, social responsibility, and financial performance. We're very much showing it's a yes and.
Yeah, and it's been working out for 5 years now.
It has. I should make the SEC happy and say past performance can guarantee future results. And you can see with the Etho index and the ETF that tracks it, it bounces up and down with the market, as you would expect. There's currently a bit over 250 companies in the US Climate Leadership Index. And so when the US market's going down, it still will go down. And when the US market's going up, it's generally going up as well. And that's usually when we see the most outperformance advantage. Overall, at least according to third-party rating services like Morningstar, it has better returns with lower risk relative to conventional benchmarks. And we're seeing what we think is this advantage, again, from just better efficiency and sustainability. And then also lower risk, we're taking out companies that are bad actors, not just in terms of climate change, but in terms of other environmental and social issues. And those issues can directly impact a company's bottom line. For example, a company like Volkswagen, for the global index that we created, we've never invested in, even though a lot of other sustainability focused funds have invested in them, simply because we've seen that they actually have been historically a very polluting firm. And that was contrary to the conventional wisdom in the sustainable investing world until just a few years ago, when it came out that Volkswagen had engineered their vehicles to cheat on emissions tests. Up until that point, most sustainability focused funds included Volkswagen because they're really good at playing the sustainability reporting game. They were great at putting out glossy corporate social responsibility reports saying that they were doing all these wonderful things in terms of social and environmental impacts. But of course, at the same time, they were engineering their vehicles to be massive polluters. And we at Etho really try to focus on diving beyond what companies say about themselves and their corporate social responsibility CSR reports, because unfortunately those reports are generally still controlled by the company's marketing departments. And if a marketing department is putting something out with next to no third-party verification and standardization, of course they're only going to say nice things about the company. At Etho, we try to dive beyond what companies say about themselves to get this deeper look at what they're actually doing. And we do a lot of modeling of the climate and other social and environmental impacts for now more than 10,000 of the most commonly traded public companies. And that's the analysis that goes into creating the Climate Leadership Index here in the US. And now we have international and global and other strategies that we're working to launch next year.
So it's clear that the climate is front and center, and you have a lot of indicators here of what you're avoiding investing in. And we've talked a little bit about diving a little bit deeper. Can you talk about what the social indicators are that you're looking at? Because I mean, equity is all over the place these days. Luckily, more and more people are paying attention. But what kind of practices specifically are you looking at companies?
In the sustainable investing acronym soup, the most common acronym is ESG investing, environmental, social, and governance investing. So the social piece, the S of that, we mostly are looking at bad actor issues. So we're looking for discrimination issues that come up with companies. If a company is the subject of pretty substantial gender or race discrimination lawsuits, for example, that can screen them out. If we see that they have corporate leadership that is not looking diverse at all, we can also screen companies out for that reason. We also look at kind of the intersection of social and environmental issues. If a company is, for example, not just polluting the climate, but also putting out specific toxic pollution that then leads to health issues and social issues, that's something else that they can screen a company out. It's really very much a case-by-case basis, trying to look more deeply beyond what companies are saying about themselves to what different nonprofits and academic research institutions and other sustainability experts are saying about what companies are actually doing.
As a practical matter, with so many companies and so many documents and so many issues, I mean, is it you and a small team of humans who are reviewing all this material and making these judgments, or do you have ways to kind of automate it?
Yeah, it's a mix, because like I said, we're looking at now around 10,000 of the most commonly traded public companies globally. And the way that we're able to automate it down to a manageable level is we have this process funnel that folks can see on the Etho Capital website if they're interested in more details, and also some interesting data visualizations around climate efficiency and financial performance. What we do is our first step of analysis is this really deep dive climate efficiency analysis, where we're comparing companies versus their industry peers. So it wouldn't make any sense to compare, say, a utility with a tech company, right? Because a utility generally is going to have much higher emissions than a tech company. So we compare tech companies with other tech companies. We compare utilities with other utilities, different types of consumer products, and healthcare companies with their like competitors. And we find which companies are the most climate efficient. Importantly, looking at not just, as probably many of your viewers already know, there's different scopes of climate pollution. And something that Etho does that's unique is we go beyond the scope 1 and scope 2 emissions for companies, scope 1 being direct emissions for companies, scope 2 being the electricity related emissions for a company. We include, of course, scope 1 and scope 2 for Etho, but then we also look deeply into scope 3 emissions connected to a company's supply chain. So all the embodied emissions that go into all the raw materials and semi-finished products that go into a company's supply chain. And it's important to look at that scope 3 piece, because for many companies, that's over 80%, can be even up to 99% of its footprint. And so for the few funds that are looking at climate, they're often missing the scope 3 piece, and they're both missing the biggest piece of the company's actual climate footprint, and then also what we've seen is the biggest piece of a signal for overall operational efficiency and better financial performance. So getting into how we make this all fit together, we start with this climate efficiency analysis that does have a whole lot of automated database work associated with it, where we build our own in-house software and done our own in-house analysis. And that helps us narrow down from thousands of potential companies to a few hundred potential companies. And then those few hundred potential companies that are a candidate for the Etho Climate Leadership Index here in the US, then we'll take this deeper, much more manual dive into looking for mostly bad actor issues associated with the full spectrum of environmental, social, and governance issues. And we do also increasingly look for companies that have a climate solution focus for what they're doing, for example, renewable energy companies, and try to give companies credit for the fact that they're reducing emissions with the goods and services they're putting out into the world. But most of our process is this combination of big data, quantitative climate analysis, and then once that narrows things down, this deeper dive into the full spectrum of environmental, social, and governance issues.
Thanks for watching. This is Energy Nerd Show and Tell.
It's the show that we want to watch, so we're thinking maybe some of you energy nerds want to watch it too. If you do, then hey, tell your friends and subscribe right around here. Click there,
And check
or there, or over here.
Instagram and Twitter and Facebook and YouTube and where
Yeah,
else?
and the Energy Nerd website at energynerdshow.com. You can always go there. And if you want to be a guest, you can volunteer to be a guest. We love to have guests. In fact, that's kind of what the show is all about.
Absolutely.